You will find the link to crypto income projection calculator in the description and pinned in comments below. Most people think bull markets are simple: buy the hype, wait, profit. But there's a hidden rotation, a silent steering wheel that moves billions of dollars between coins, wrecks portfolios, and makes winning traders look like geniuses. In the next few minutes, I'll show you how that rotation works, how investor psychology drives it, and the exact signals most beginners miss so you don't lose your runway when it matters most. You will learn three clear stages of capital rotation, the psychological traps that blow up beginners, and a step by step checklist you can use next trade day. I'll also reveal one surprising pattern almost no one talks about and how it completely changes where you put your money. Watch till the end and you will get a simple rule that could save your portfolio. If you want clear, no fluff crypto breakdowns designed for beginners, subscribe now. I post documentary style explainers that cut through the noise and help you trade smarter. Imagine a giant invisible crowd moving from one room to another, whispering hire or sell as they go. That's capital rotation. Capital rotation is money shifting between sectors or assets during a market cycle. In crypto, that usually means money flows from Bitcoin to large cap altcoins, then to mid caps, and finally to speculative small caps before reversing. Think of it like waves on a beach. The first big wave is the Bitcoin, the second pushes into established alts, and the third splashes into risky bets. At a concert, early adopters snagged front row spots, that's Bitcoin, then the crowd spreads to the main flow, large caps, and finally to side stages when crowd feels confident, small caps. This movement creates two emotions: fear of missing out and greed, chasing quick gains. Beginners feel both and often follow the loudest voice, which costs them. But why does money rotate this way? The answer exposes a psychological script traders rarely notice, and it changes everything about how you trade. There are three mental shortcuts everyone uses in a bull run. If you spot them in your thinking, you can spot where money flows next. The first script is social proof. If everyone's buying, it must be right. Humans follow crowds, and volume and hype amplify this effect. A social media buzz about a token leads to retail buying, which pushes price and invites more buyers. The second script is narrative comfort. I understand this story. Money moves to stories. Decentralized finance, meme coins, NFTs, layer 2's narratives. Layer 2 narratives because traders pick assets they can explain to friends. The third script is anchoring. My reference price is Bitcoin. Many compare alts to Bitcoin performance, and when Bitcoin rises, alts seem cheaper relative to potential, so money rotates. Think back to decentralized finance summer, meme coin spikes, and rotation into layer 2s in later cycles. These are examples of those scripts in action. These scripts create herd behavior. Herds move fast and they trample anyone standing still. Next, we will look at the exact technical and sentiment signals institutions and smart money use to start those rotations, and how to read them before prices explode, before money rotates. Three signals almost always flash red. Recognize them early and you get optionality. Miss them and you are reacting. Signal 1 is a Bitcoin micro top with volatility compression. Bitcoin shows lower highs and shrinking volatility while altcoin volumes begin to spike. Signal 2 is funding rate divergence. Perpetual futures funding rates for alt spike positive earlier than Bitcoin, indicating institutions leaning into alts. Signal 3 is concentrated whale movement, large wallet transfers from exchanges to decentralized finance or specific token holdings visible on chain. A whale buying into an emerging market to a layer 2 before social buzz can be a leading signal. You can spot these signals with on-chain explorers, funding rate charts, and exchange flow trackers. These are quiet warnings, and most beginners only notice after the surge, which is too late. But these signals can be faked or noisy. I'll show how to filter real rotation signals from false alarms next. What almost nobody tells beginners is rotation often starts not with retail but with liquidity squeezes engineered by large players. Large players hunt liquidity to create the price movement they want. They push price into stop clusters, trigger liquidations, and then use that liquidity to load into other assets. Imagine Bitcoin in a sideways market, a sudden $2,000 drop clears stops, and then Bitcoin quickly recovers as whales buy cheap. That cleared liquidity then funds rotation into alts. This is scary because it means the market can feel manipulative, but understanding liquidity hunting gives you control. Next, I'll give you practical rules to avoid being the liquidity harvested and a checklist you can use every trade day. Three rules protect your capital during rotation. Break any one and you will most likely lose in a bull run. Rule 1, scale in. Don't FOMO by use staggered entries tied to levels and signal confirmation. Rule 2, reduce position size during peak hype when funding rates and social metrics spike. Cut exposure. Rule 3, keep a core Bitcoin allocation. Maintain a core of 30 to 50% of crypto capital in Bitcoin to ride cycles and avoid being fully rotated out. Here's a simple trade day checklist. Check Bitcoin dominance and 24-hour alt volume. Review funding rates for the top 20 alts. Look for large wallet transfers and exchange flows. Confirm narrative strength with social sentiment and news. Decide position scaling and exit levels. These rules trade the emotion of FOMO and panic for calm, repeatable steps. Next, I'll show how to use position sizing and stop placement specifically during rotation to protect gains and play for upside. The same stop loss that saved you last month can gut you during a rotation. Here's why. Here's a difference between volatility aware stops and fixed percent stops. Volatility aware stops use ATR or recent swing structure to avoid whipsaws. Fixed percent stops are simple but can trigger unnecessarily in crypto's volatility. In one example, a fixed 5% stop triggers on noise while an ATR stop survives and wins. Use a core and trade sizing method, core holding of 30 to 50% with no stops, and tactical trades of remainder sized smaller with volatility adjusted stops and clear targets. Stops feel safe, but the wrong kind creates paralysis or loss. Position sizing gives you psychological breathing room. Up next, I'll give the the exact checklist to run before moving money into an alt, plus examples of trade that obeyed the checklist and ones that didn't. Two short stories, one trader who rode rotation and one who lost everything. The differences are tiny and almost invisible. The rider kept 40% Bitcoin core, watched funding divergence, scaled into layer 2s after whale transfers and social whisper, used ATR stops and took profit back into Bitcoin. He walked away with about 3 times his risk on that trade. The chaser FOMO bought a small cap memcoin at its all-time high during social peak, used a fixed 5% stop, got liquidated on volatility and watched the coin fall 90%. The riders' decisions were deliberate and process driven. The chasers were emotional and reactive. These stories make the consequences real, not theoretical. Now we will pull everything into a single playbook you can use the next market day. One page and 5 steps is all you need. Use this every market day. Step 1, warning scan. Check Bitcoin dominance, alt volume, and funding rate divergences. Step 2, confirm Narratives: review the top 3 trending stories for the week. Step 3: whale filter. Look for large transfers to specific tokens or exchanges. Step 4: scale in plan. Allocate core versus tactical. Set ATR based stops and set profit targets back into Bitcoin. Step 5: exit and reevaluate. To take profits into Bitcoin at predetermined levels and never go all in unless your thesis changes. Walk through a quick hypothetical. Use spot funding divergence scale into a layer 2 and take 50% profits back to Bitcoin when alt market cap grows 20%. You protect gains and stay positioned for upside. This playbook converts chaos into repeatable decisions and gives you confidence. One last psychological tip ties everything together and builds better trading habits over time. The most profitable traders treat markets like hypothesis testing, not gambling. Frame every trade as an experiment. Write your thesis, decide on a time horizon, and set outcomes that prove or disprove your thesis. Log results and learn from each trade. Over time, your edge compounds not from luck but from disciplined learning. This reduces regret and emotional whipsaw and makes losing tolerable because you are learning. If this breakdown helped you, subscribe now and join the community. I post weekly documentary style explainers that turn confusing market behavior into clear rules. Before you allocate any profits, watch the next video where we discuss staking, decentralized finance, and Ethereum based investing. That video will show you how to park gains safely and earn while you wait for the next rotation. But before you move money, watch the next video where we discuss staking, decentralized finance, and Ethereum based investing. It could save you from one of the biggest beginner mistakes in crypto.